Welcome back to MoneyFlow Vision on Sunday, August the 4th, 2013. This video illustrates how to interpret this week's Bucket Weekly newsletter that you've just received. The Bucket Weekly newsletter is packed with valuable insight, and we want to share with our premium members how to get the most out of it. Now, watching this video does not mean that you do not have to actually read the weekly analysis. Don't be lazy. Before we begin, this is not financial advice. Please seek the counsel of a financial professional before investing. Investing in stocks, options, futures, commodities, and currencies carry risks and can result in financial loss. We always like to start the week off with a recap from the previous week. So if you've already taken the time to read the Bucket Weekly that you've just received, you'll know now, and we hope that you've been following the stock market or the markets for the past week. You know that the S&P 500 eclipsed the 1700 point level, which we've been waiting for a number of months if you have been following our weekly analysis. And it's a very bullish sign that the S&P finally hit the $1,700 point mark, and it was with some good enthusiasm on Thursday, as you can see by this price action where my mouse is. And the best performing market this past week was the NASDAQ. We didn't have any positions in the Qs. We had our position in the SPY instead. So if you've been following our analysis for a number of months now, we actually were anticipating the NASDAQ to head towards the $3,700 point to 4,000 point level a number of months ago. It has taken some time, and in hindsight, we should have just taken the Qs for this long run. But again, that's hindsight. It's tough to say that the markets would have, gone up this far in such a short period of time. But we were expecting it. We just didn't want to lay down all that risk for such a long time. Now moving forward here, we offered this MoneyFlow Pure Pick to our subscribers on Thursday of last week, and it's done reasonably well in about a day. We're going to stick with it. If you haven't gotten into it, that's okay. Maybe you'd like to wait for a retrace. We'll come up with some more commentary as the week progresses. So let's get started here. And we always begin with the economics. We feel the economic indicators are really what will drive the markets eventually. The only way for the retail investor to see that is through the charts. That's why we saved that for last. So for the upcoming week, we've highlighted here what we feel is the most important economic indicators out there for you. And that will start with the Reserve Bank of Australia here on the 6th. They're talking about dropping the rate some more. And then there's pundits out there saying that they're going to keep the rates at 2 3/4. And you can see that reflected in the Australian dollar. It's been punished. Okay. Historically, the Australian dollar is a currency whereby if you see the appreciation or it's trading up and it's strong, because of the high interest rates, it's a way for investors to get a temperature check as to how much risk or excitement the global investors are willing to take on by buying more stock. Also on that day, we have Japan that's going to come out with their interest rate decision, and I don't even know why this is news. I don't think anyone wonders why this is still news. It's the rates are near zero, so unless you're going to do something about it, or unless the Bank of Japan is actually going to raise rates, there's no point in even talking about this in the news. The most important information that we feel is out there that's going to come up this week is going to be the trade numbers coming out of the United States and China. They are obviously, we feel, either 1 and 2 or 1 and 3 in terms of the size of their economies across the world, and their trade balance or imbalance is a very strong temperature check as to how much they are producing and how much they are consuming. And that does affect the global markets, the equity markets. And then to the end the week off, we're expecting the initial jobless claims to actually be higher. Now, understand that the last few weeks or a few weeks ago, the job numbers were a lot better than expected. So, you know, you never take these indicators week to week. It is the trend. That's why we offer the trend here on the right-hand side to give you a real understanding of what's going on. Even if the analysts are expecting a greater number of jobless claims this week, the trend is actually still down, and the unemployment rate continues to tick down, albeit at a very slow pace. It's still ticking down, so more and more people are actually getting new jobs, or not new jobs, but I should say getting employment. So let's move into our Euro futures here. And, when you're reading this weekly, it's not good enough that you just read it. I mean, we take the time, and you've invested your time and your money. Take these levels that we've offered you and replicate them on your trading platform so that you can follow day to day, week to week. And it always reinforces what it is that you're trying to accomplish here, which is financial literacy. It's not good enough to take one piano lesson a week. It's not good enough to take one karate lesson a week and expect something positive to come out of that once a week lesson. You got to reinforce this each and every day if financial literacy is something that you want, and if you want to create income and wealth from the markets, you got to put in some time. And it's not just about reading our weekly analysis when you receive it on the Sunday evening. So let's look forward to the Euro futures here. And, we expect that the Euro should continue to go higher based on the technicals that we are looking at. The only thing that can pull it back would be the GDP numbers, or the preliminary GDP numbers coming out of Italy, which historically, or for the past number of years, it's been weak relative to Germany and France, and the German production numbers can also affect the euro. That being said, we remain bullish in the euro based on technicals, and those two economic indicators can be the two catalysts that may pull the euro back. Now, you might not be trading euro, and that's fine. We're using the euro as part of our correlation model. And as you read the weekly, we always refer to the current market correlation model, which is when the US dollar is up, equities should then move upwards and follow along at some point in time. In recent weeks, we've been looking for a break in that correlation, which means if the US dollar trades lower, the euro may start to move higher, and resulting in pushing the equities higher. As you have probably seen based on the chart, the US dollar is actually traded lower while the equity markets continue to run higher, and the euro and the sterling continue to run higher. So we remain a little bit bullish here. There is just a couple of forces, that being German production, industrial production, and the Italian GDP numbers. That being said, we remain bullish, and we might even look to enter in a euro trade here in the coming days. So let's move forward here now. As you can see, we are getting still some bullish signals out of the pound. It may consolidate based on the price action. You can see here it's gone sideways. We were expecting a larger range. We were expecting pound to trade higher. It's stalled a little bit. So let's see if it can trade through these two little lines, or our resistance levels here. If it can trade through, then we'd be in good shape. Now, from a correlation perspective, if the euro continues to move up, if dollar trades lower, if the British pound is able to punch through these levels here, and the result is that equities continues higher, then we know we have confirmation that the correlation has changed from dollar up, equities up. It would then be dollar down, euro up, pound up, and equities up. So we're always looking for signals to help us time the markets. A lot of times you'll run into people and they're saying, well, the correlations aren't the same anymore. Well, that just sounds like someone who's just given up. The correlations are never always going to be the same each and every month or each and every year. They do change. Money has to flow. Sentiment changes. It is our job as investors to always follow that sentiment to get the most high probable trade. Here's an illustration of what we talked about earlier on. It is the Australian dollar futures. Look, it's completely fallen off continuously. It just can't hold. And now that the analysts are expecting the Reserve Bank of Australia to possibly lower rates some more, we're looking at a 3-year graph now, and we can expect the Australian dollar to touch down at these levels at some point this week. Now, it may be a decent time to take a short-term opportunity on the Australian dollar because we're timing this entry with the beginning or the origination of the move starting over here. And this move started the rally all the way up. Now, I'm not going to say that the Australian dollar is just going to pop all the way back up. At least you know at these levels there's a lot of interest. A lot of interest means you have a higher probability of success that the idea will work out. Now, we aren't using the Australian dollar within our model right now. We're just showing this to you from a trading perspective where you can find opportunities. Our Bucket Weekly newsletter, now whether you find your own trades or not, that's up to you. Whether you trade or set the opportunity alerts that we offer, that's up to you. There are so many ideas packed within this, our Bucket Weekly newsletter. It's silly. It's silly. People just may or may not realize it, but we've identified trades all over the place. It's up to you now if those are the ideas that you'd like to take on. All right, let's keep going here. The Canadian dollar looks technically weak. It's closed below its 50-day moving average and the 20-day exponential moving average, and it actually closed below these levels. It couldn't break out. You know, if you were following us last week, we expected a little bit more pop as the US dollar kept getting slammed. But as you know now, the US dollar had made a little bit of a move. The Canadian dollar then was subjected to that sell-off. This is where it gets a little interesting. You know, historically, equity markets move up as yen moves lower, and the yen hasn't moved down enough recently. It's actually been channeling along while the equity markets continue to move higher. So we overlaid the S&P 500 chart on top of the yen a few weeks ago to highlight this correlation. It's actually positive. It's somewhat positively correlated right now, which it's a little strange. I haven't seen it before. And, you know, we would prefer that the yen continues to sell downwards to feel more comfortable maintaining a long equity position. So, you know, to put that in plain English, yen moves lower, we'd like that. We'd like the yen to continue moving lower while we are holding stock long and feel comfortable with it. Now, if you have followed us and you've entered all your lines, we've had to update the levels for this week in the US dollar as well. We want now to see if the dollar can break through these levels. Now, based on the current correlation model, if the US dollar can break through these levels and we see equity markets continue to push higher, then we won't have to think so much about, is the correlation model changing? Now, if dollar cannot break through these levels here and it sells off and starts heading lower down here to around the 81.12 level, and equity markets then continue higher, then we know that the correlation model is changing. We'll know that euro would continue higher, the sterling would have broken through those resistance levels, and we know we'll have confirmation finally that the correlation has shifted from dollar up, equity up, to dollar down, euro up, pound up, and equities would then follow suit in that pattern. Now, if the market, based on that correlation, if the market moves into that correlation, then if dollar then trades up and euro moves down, then we might see equities trade lower. Okay? So again, it's not good enough that you just listen to this video. Read it. Read the weekly. Read it twice if you have to. And then install these levels, these lines on your own trading platform so that you can follow each and every day so that you can acquire the financial literacy. Now, crude, we remain bullish on that. Price has not hit our targets yet. It's traded through the levels, which is a decent sign. It stalled a little bit last week, but we're not going to modify our graphs at this point in time as we feel that there's still more upside in crude. Copper rallied. As you can see, it's channeling, and it creates a very, very good short-term trading opportunity from these resistance levels here. As you can see, on Friday, it just could not pierce through. This is why it is really important for you to identify quality levels. We'll be providing lessons for our premium members later on to help you identify where you can install these levels on your own at some point in time in the future. Nat gas, same story. It's, we started looking at natural gas back up here at these levels. We did not take the play on it, but as you can see, if you get your levels right and you get your timing down, you could make a lot of cash just using our analysis, okay? Nothing new to write about wheat. Wheat continues to get slammed. Soy and corn, excuse me. We've been waiting for a rally upwards. We're just not getting it, so we had to keep revising down our turning point. We really think that when the time comes that corn and soy will turn around, there's going to be tremendous money to be made here. Okay, look how long this retracement is going to be. We actually want corn to retrace back up to this level up here. And if you get this one trade right, this one trade will make your entire quarter. It can make 6 months worth of profit. You'll make bank. You just have to wait for it, okay? And this is why we've identified these levels. I can't stress it enough. Install these levels on your own platform and follow along. Okay, this is how financial literacy is formed. It's not done by reading this weekly newsletter, once on a Sunday. It's got to be done every day. I have identified a strong opportunity here in gold. We want to see price break down below 1265. It's not too far away. We feel that if price does trade below, and it's got to close below, don't just take it intraday. If it closes below this level, there's a good opportunity that gold will head down to about the 1215, and if 1215 doesn't hold, then we feel this 1180 range is in sight as well. So we may offer for the first time a gold trade. We just have to wait for the setup. But again, install these levels on your own platform and follow along. Okay, futures in silver. Same story here. It's just beat up. We're not gonna offer any real opportunity here. It's just not worth it at $19 right now, and you can see it's not too far off from the multi-year low here set back in 2018. at 1773. It's currently, or when it closed on Friday, we're looking at 1984. So we'll just wait for that level. But I think if you're going to enter into a precious metal trade, it's probably better that you take the gold trade over the silver trade. Now, moving on with our correlation model, we've talked about the rising yields over the past few weeks, and they're still rising. Now, rising yield is not historically conducive to the equity market. Although the equity markets continue to rise and yields continue to rise while these notes sell off, that just gives us a little bit of alarm bells here. We want yields to come down a bit to give us a little more comfort with holding equity positions long. It's just like how we mentioned about the Japanese yen. We'd like the yen to sell off some or trade lower to give us added comfort and add some probability that the market will continue higher. Okay, moving forward to index futures. The index futures look healthy. It doesn't matter if it's the S&P, it doesn't matter if it's the NASDAQ, it doesn't matter if it's the Dow futures, it doesn't matter if it's the Russell futures. They all look healthy. What we've done for you this week is we've just updated the levels. We moved them higher to help you with your market timing efforts. Now, when we say that the markets are healthy, that does not mean that they're just going to go straight up from here on in. Always expect a little bit of a pullback and then a continuation. Okay, that's what we mean by healthy. Obviously, it would be nice if everything just went up in a straight line, but that's not being realistic. Okay. Now, our broad markets here, we've set it up. These purple lines here, I illustrate where we feel is a good support level for the S&P to trade down to, and that would actually allow us to even buy more SPY contracts or more of the underlying stock to get back in. That's how a lot of money can be made if you buy some on the dips. I'm not saying average down. What I'm saying is play the trend. If the trend continues to go up, buy more. There's nothing wrong with it. We still feel that there's upside to the S&P, and again, that is not without any technical retracements. Our initial target for the S&P stands at 1712, then 1729, and then further up the road at 1761. But as proactive investors, take it level by level. Now, for those investors who have been holding the stocks a little bit longer term, we've identified down here about 1657, 1645 as added support. Okay, if you just got into the markets in the last 2 weeks, you don't want to be waiting down to 1757 or 1745 to dump out of your positions, because you're going to be losing more than what you bargained for. This level is strictly for those investors who have been in their positions for quite some time, who are very profitable, who wouldn't mind buying more at those levels, or if the S&P closes below this 1745 level, it may be time to take some money off the table. Okay? Dow looking good. NASDAQ looking great. The Russell still looking good here. We like it. We may actually look for some ETFs on the IWM. And let's move into our sector analysis. The industrials were very, very strong this last week. As you can see, we did offer an ETF trade on the XLI, which is doing reasonably well at this point in time. We've identified the first target to be at 46.32, 47.01. After that, there could be a bit of a cooling off period before a run to $49.50. Most of the ETFs that we see out there, most of the sectors that we see out there, have at least a 8 to 10% premium that they can run to. We're still bullish. We like it. Again, this is not without any technical retracements. We feel that each sector has about an 8 to 10% run here, and that's why we're still holding on to our ETFs based on the sectors that we like. The materials sector has been a little bit choppy. choppy. It's still going upwards. There's more volatility within this specific sector, and the ranges are fairly large. So if you're going to take an opportunity within the material sector, your stop has to compensate for the vibrations of the stocks or the actual sector. And we'll be providing videos on that later on and really show you how you can create levels that will compensate for the day-to-day vibrations or the individual personalities of each and every sector. We still like this. The ETF did trade through our first target, so we're happy about that. And we expect the material sector to move up to about 41.38. Now, I can't tell you when that's going to be. We don't have a crystal ball. We just feel based on price action that should happen. All right. Now, the transportation sector, strong as well. Hit the target on Friday. Now, keep in mind, when you set up a trade, even if the stock or the option or the future or whatever it may be doesn't run to target, that doesn't mean that you can't take money off the table. Now, that's not a green light to just start taking money off the table when you're making $10. You have to have reason for every time that you don't want to hold any longer, whether you're long or short. This is why we're stressing financial literacy. This is why we're stressing the use of this multi-asset model so that you can really, really see how money is flowing within each sector. Now, it's okay that you can trim some inventory off the table. If it hits a target, it's okay to trim all of it off, but you have to have a reason for every time you execute an action. Okay, that ultimately will help with your skill. It will help with your financial literacy and your education. The retail sector here is looking fairly attractive. We waited 2 weeks for the sector to break out. As you can see here, this consolidation, and the psychology behind that is that the institutional investors just don't want to place their bet, so to speak, until someone jumps in the pool first. And guess what? On Thursday, someone jumps in the pool, and here we go. So we've provided further guidance here at 85.68, 93.11. Obviously, 93.11 is a little bit farther away. However, we feel that if we manage this sector accordingly and manage this play accordingly, in conjunction with the correlation, wherever it may be at that time. So if the correlation stays the same, dollar up, equity up, then we'll be in good shape. And if the correlation changes from dollar down, equity up, we'll be in good shape. But we still need to know what that correlation is going to be so that we can manage this position so that we're not caught with our pants down. Now, moving forward to the utility sector here, it has done well. It's like the material sector where it's choppy. However, it's still traded upwards. So know that with a sector like the utilities, you may need to have a little bit of a wider stop to compensate for the vibrations within within the sector. And we feel that this sector is still in decent shape here to hit the first target we set at 40.06, and then it's tough to see anything beyond 40.46 at this point. As you can see, there's an origination of a big sell-off down here. So just keep that in mind. Install these levels on your trading platform so that you can really, really stay tuned with the dynamics of the market. Healthcare, we avoided this sector last week. It was doing well. It's flattened out a little bit here, so we're going to still avoid this sector. However, it's still in decent shape. Okay, it's not leading. It's not completely fallen off. It's still moving upwards, albeit at a very slow pace. So we're just going to avoid it for now in terms of investment opportunity. However, we still, because it is seen right now as a little bit of a laggard, if the weaker sectors, so to speak, start to sell off, then you know that there is money being taken off the table, and it could then drag the other sectors down. So in an up market, you want to look for the strongest sector, because that sector should outperform the S&P or the Nasdaq, etc. In a down market, you want to look for the runt of the litter, because the market or that sector or that stock will move down much faster than if you were to short the stronger sector. Okay. Technology, we didn't get in any plays there. However, you can see technology is converging pretty quickly to our first target and our second target. It's not too far away. We've provided further guidance here about 33.74. So if the technology sector clears these levels, it'll be in good shape to reach this 33.74 mark. So all in all, we expect that the markets are going to still move higher. They're technically very strong. All that we need to look out for this week is the trade balance numbers from the United States and China. We want to look for inflation from China and pay attention to GDP from Italy and the industrial production from Germany. So again, all in all, the markets still look technically strong. Just pay attention to this economic data and look out for the continuation with the current correlation model or a switch, okay, from dollar up, equity up to dollar up, from dollar up, equity up to dollar down, equity up. So pay attention, install these lines on your own platforms, and you're on your way. And financial literacy is just around the corner, and at some point you're going to be able to find your own ideas, you're going to be able to find your own trades. We'll be providing in the future lessons on how to identify where to install these levels, which will really, really change the way you look at the markets and really, really up your skill level. Thank you for stopping by The Wealthy Bucket.